Hi, this is the final accounting review for IME for the fall. I need to break this up into several videos because they end up being too long to go onto YouTube. The first video deals with the information you were sent, and it's actually part one of that, where I'm going to prepare the income statement. You were first asked to prepare a balance sheet and an income statement, and you were given information on a form of a trial balance. You need to create the financials from them. But before you get there, you need to stop and think about the basics of all financial statements. The basic idea is to remember what each statement is for. The income statement shows revenue minus expenses. The balance sheet shows the accounting equation of assets equals liabilities plus owner's equity. And the statement of owner's equity or retained earnings shows the balance and how it changes through the years. We're going to first look at the trial balance, and we're going to move from there. As you look at the trial balance, you have a list of all the accounts. The easiest thing is to first go down one by one and mark down exactly what kind of information is contained in that account and on what financial statement that account should be placed. For example, cash. Cash is a current asset. It is cash, and it's going to remain cash. Accounts receivable is also a current asset because it will be converted to cash within the next year. Inventory is also a current asset because it will be sold and converted to cash within the next year. Those are the ideas behind your current assets. Equipment is a non-current asset because your equipment will not be all used up within the next year. But it will be used to make money, which will in turn come back to become cash, but it takes longer than a year to do that. Accumulated depreciation is also a non-current asset, but it offsets the equipment. You can see that one is actually a debit and one is actually a credit balance. That's simply because the accumulated depreciation shows the wear and tear of the asset itself. So it offsets that balance. Now we have accounts payable. That is a current liability because we're going to actually pay that with cash in the next year. Notes payable is a non-current asset because a note payable is a formal agreement, usually with a bank, but it takes more than 1 year to pay back that amount of sum. Now we have common stock. If you remember, we talked about there's two different kinds of owner's equity. There's the owner's equity that shows the owner's portion, and that is the common stock. But then there's the owner's equity that shows the earnings portion, that's retained earnings. But you need to be careful with this retained earnings. This $7,500 is the balance at the beginning of the year. What goes into retained earnings is all those items that go on the income statement. That's all those that are below it. Because sales is a revenue item, and that goes on the income statement. Cost of goods sold is an expense. Salaries expense is an expense. And utilities expense is an expense. Those items all go on the income statement. Now that we've set those up, we can set up our income statement. The income statement starts with the title, the name of the company. Then we say what the statement is. In this case, it's an income statement. And with all financial statements, except for the balance sheet, we turn around and say, for the year ended. Now, if you remember, the balance sheet is the one that doesn't, and it just has the date. Now we go ahead and we start with the financials. We start with the actual revenue minus expenses. So we have revenue, which is actually sales. So it actually would be better if we would use the term sales. And we have $11,000. We're going to subtract from that the cost of goods sold. That amount of $5,500 leaves us with an amount of $5,500. That is our gross profit. This is an important term that you really need to make sure you know. From our gross profit, we subtract out other expenses. That's where we have salary expense of $3,500 and utilities expense of $1,000. Those expenses cover $4,500. I could put the total down here, but I can also save some space. And as long as I have a line here, a single underline, and I have a number next to it, I'm automatically signaling people that that $4,500 is the total of the $3,500 and the $1,000. Once I have that there, I'm going to take my $5,500 gross profit minus my $4,500 total and other expenses, and I have $1,000. That is my net income. Now we do have to worry about formatting. The purpose of the income statement is to show the net income or loss, so I'm going to double underline it. I'm going to make sure I have commas everywhere I need a comma. And I'm going to go put a dollar sign at the top of each column and at the point of my financial statement. And that's how we build an income statement. I need to make sure that I show that the net income for my future statements is equal to $1,000. So I'm just going to make a note of it over here. You don't need to do that. I'm just doing that for the purpose of this demonstration. Now I'm going to show you the statement of retained earnings. That's actually a very simple statement, and you weren't asked to do this as the problem, but if you have to do an income statement in the balance sheet, you do need to know that that's how you connect those two statements. You start off again with the name of the company. Actually, and since we're dealing with a subset of owner's equity, we're dealing with the retained earnings, I can go ahead and call it the statement of retained earnings. Sometimes you're going to have to deal with the change in the actual common stock and the change in the owner's equity in that sense, and you deal with the earnings portion, so you might make a bigger statement. But for here, we're just fine doing the statement of retained earnings. But remember, it's for the year ended. All that happens in the statement of retained earnings is I start with my retained earnings balance at the beginning. That was with $7,500. I'm going to add my net income that I know from my income statement was $1,000. And I would subtract out my dividends, except I really don't have any in this case. So I end up with a retained earnings balance at the end of $8,500. Now I can't forget to go ahead and do my formalities and make sure I've got everything lined up right. So I put a dollar sign at the top and a dollar sign at the purpose of the statement of retained earnings. And of course the statement of retained earnings purpose is to show the ending balance of retained earnings and what happened during the year. So I've done that. Now what I do need to do is keep track and note that my retained earnings balance at the end is $8,500. I need to keep track of that because that's the part I'm going to continue with on the next video, the part 2 of this video, where I do the balance sheet and the break-even part of this problem.